Ajay Shah, Senior Fellow with NIPFP, joins us live. Ajay, good morning. Thank you for joining us. Ajay, last time when we interacted with you on this forum, there was gloom and doom. Rupee was in a free fall, bond yields had gone up, there was a rout in emerging market equities. Things are now looking stable. Do you think the storm has come and gone, or this is just temporary reprieve?
Depends on what horizons you want to look at. I think there are two big areas of concern. The first is that domestic economic conditions are bad and are continuing to be bad. In the latest available quarterly GDP data, which is the April, May, June quarter, on a point-on-point seasonally adjusted basis, if you look at the non-government and non-agriculture part of GDP, we got minus 0.5. Okay, now this is really something. In India, to get negative GDP growth is really something. So things are quite bad in the local economy. And on top of that, we have 10% inflation. So in the local economy, things are bad. The second is on the conditions on international financing. This entire drama of middle 2013 came about when Mr. Bernanke started a discussion about future states of nature under which he would be binding back quantitative easing. Okay, so he hasn't done anything yet. He's only embarked on a discussion of what he might do when. And we saw all the consequences for the world economy and in particular for capital flows to emerging markets. Now, it is essentially certain that over the next 2 years, 3 years, 4 years, reasonable men can disagree over whether we're discussing 2 years or we're discussing 4 years. But over the coming 2 to 4 years, the entire quantitative easing program of the US Fed will be unwound and interest rates in the United States will normalize. Now that's going to be quite a storm for emerging markets. So we've only got a tiny foretaste of what's to come, and I think all of us should be getting away from the minor events that we have had and think more constructively about where we are going in the next 2, 3, 4 years.
But Ajay, how does a domestically driven economy like India get out of the downturn? We've got problems of our own, clearly.
We've got the elections in May 2014, and that is indeed a big source of uncertainty. Over the last 20 years, by and large, we have come through with fairly stable governance arrangements. We have generally, though not always, had high-quality finance ministers. Okay, so I am relatively comfortable about what the elections hold. And I think that the political masters are also increasingly understanding that you need a technocratic and a non-corrupt finance minister. So, I think there is grounds for hoping that we will not have another disaster of a collapse of governance with the Minister of Finance. Now, what are the sources of hope? How will this end? How do business cycle downturns turn themselves around? So one big factor acting in our favor is rupee depreciation. Okay, this is the single biggest source of optimism about the Indian economy, and particularly if policymakers will get out of the way and allow the market to do the full-blooded depreciation that we need, then that is one powerful source of recovery. Conceptually, rupee depreciation drives the margins, the profitability of the firms, and thus their investment. It is interesting to see that in June, July, August, September, which is precisely the period when we had a big rupee depreciation, conditions globally on the prices of tradables deteriorated considerably, and it was only our rupee depreciation which has given us roughly flat conditions on the prices of tradables, which has a big impact on the profitability of a large chunk of manufacturing. So one big story about how we will come out of this is in the rupee depreciation. The other part of the story lies in how there is a churning in the world of firms. In bad times, weak companies go out of business, the crooks get exposed. So I always love to say that recessions uncover what auditors cannot. Okay, so we have seen one after another rotten apple falling out and collapsing by the wayside. And that's a wonderful thing that downturns do. Downturns are a cleansing of capitalism. So the weak firms go out of business, the bad firms get exposed. There is reduced demand for real estate. There is reduced demand on the labor market. So the price of real estate and the price of labor corrects itself, and you set the stage for a next expansion. So, firms are digging in every day and fighting to become more productive. And that's a good thing. That's how business cycle downturns work themselves out.
Ajay, that's a fair point and brilliant analysis. But I have a follow-up question on the part one of the story, which is the currency, depreciation and how that will make life easy for companies which are exporting and how companies which will benefit because of import substitution. Now, for exporters to make money, global demand has to remain strong, or global demand has to come back. If US economy decides to increase interest rates, do you think that will hurt global demand and the demand for exporters will not be strong?
But Mr. Bernanke will only raise interest rates. Mr. Bernanke's successor will only raise interest rates when the United States economy comes back. So let's not lose sight that there is a financing side to what's happening in the US economy. But actually, we should all be celebrating. We should be distributing pedas in the streets because the US economy is healing. So Bernanke has been very clear. I will normalize interest rates when the data shows that the US economy is healing. And that healing is very important for us as India and more generally for the world economy.
The other flip side, Ajay, is that the domestic demand, for domestic demand to come back, sentiment has to improve and interest rates have to come down. Reserve Bank of India last week has made it clear that the interest rates are inclined to go higher and they will go higher, and demand clearly is not making a comeback because the entrepreneurial spirit of the country has taken a whack.
So, first and foremost, the mood amongst entrepreneurs is shaped by profitability. Okay, so let's preserve a sense of perspective that interest rate is one part of the situation inside the firms, but ultimately it is profits. So you've got to look at the profit rate, and that's what shapes the optimism in the country. And that's where I go, that the exchange rate depreciation is a powerful source of assistance to the profitability of anything that can be traded, not just the exports, not just the import substitution. Any goods where goods arbitrage is feasible has a domestic price that is determined by the world price multiplied by the exchange rate. So that's one part of it. Now, on the interest rate situation, it is a really tough call, and I am 100% in favor of low and stable inflation as the primary, if not the only goal of monetary policy. But I think it is time to step back and look at the situation that we are in. First, if we've got an output collapse in our midst, that presages a correction of inflation, and that is one factor that should go into the policy making of a rational inflation targeting central bank. Second, I feel that there is an important part of our inflation crisis which has to do with the unhinging of inflationary expectations. It is not as if the conditions on credit growth and some of the other monetary aspects of the economy have gone way out of whack. We had a great credit boom in 2005, 2006, 2007, 2008. Okay, at that time, monetary policy was completely out of whack. We had a great business cycle expansion and we had 35% growth in bank credit. That's not where we are today. I feel today at the heart of our inflation problem is the unhinging of inflationary expectations. This requires setting up a sound monetary policy framework. So I think that Raghuram Rajan's first statement is to some extent on the right track, but I think a lot more needs to be done to clarify the objectives and the instruments of monetary policy. An intelligent layman like me who reads the monetary policy announcement should be able to understand what is going on. That was not the case with what happened in this recent announcement. There should be clarity about what is the objective of the RBI, what are the instruments of the RBI, how will RBI behave in the future when faced with data in the future. That's what should be clear. If we are able to convey clarity about what monetary policy will do, then I think we can come back to anchoring of inflationary expectations.